Well, from today onwards, I am starting this very important series. I call this series Trades Not Taken. In this series or playlist, I want to discuss those trades which meet all of my criteria, my basic filter criteria, plus my chart filters criteria. But for one reason or another, I end up avoiding the trade. I end up not taking the trade. So I want to discuss why I do that. And I also want to discuss that if I don't take a trade, what happens after that? Sometimes, if I don't take a trade, the stock continues going up. Sometimes, if I don't take a trade, the stock comes down. So, we have to see if we select a trade, what happens after that? If we take a position, what happens after that? Which I'm already doing. I'm already sharing my trades with you in a playlist called My Trades. But it is as important to reject stocks as it is important to select stocks. In fact, I would say rejection of stocks is a far more important skill than selection of stocks. Okay, selection of stocks is easy because when you see a chart pattern or when you see a good tight base, it is almost like a no-brainer. If a base when you look at a base and you feel like, okay, I have seen this before, and this is the perfect chart pattern that I'm looking for, and it's a no-brainer where the base does not force you to think. If a base does not force you to think, that's an ideal base. But if a base is forcing you to think whether you should take the trade or not take the trade, then in 90% of those cases, it is recommended that you do not take the trade because the base is trying to tell you something. The market price action is trying to tell you something that this could be a trap. Okay. So that is why I say it is important to learn how to reject stocks as well. Majority of our trading performance is determined by the trades that we don't take rather than the trades that we end up taking. So that's a little introduction before I start this video. And this is the first stock that I want to discuss in this playlist. This is called as TD Power Systems. And I did not take this trade. And look what happened. Okay. Let me explain why was I considering buying this stock. So on this day, this is what I saw. Okay. And you see, if I put the moving averages, the blue line is the 50-day moving average, and the green line is the 150-day moving average, and the red line is the 200-day simple moving average. We have the blue, green, red combination. That means it is a nice stage 2 uptrending stock. That is one criteria that I look for. The second criteria that I look for is the base. How is the base? Okay, let us look at the height of the base. So this is the highest point in the base. This is the lowest point in the base here. So the height of the base is less than 15%, which is fantastic. Okay, not the stock has not given up more than 15% from the top. Okay, which is fantastic, very encouraging. If the stock would have given up like 20, 30, 40%, okay, that's a problematic base. Okay, the stock needs to recover a lot. It has to cover a lot of ground before it surpasses or passes this point number 1 to start the next leg of its rally. So the tighter, the smaller the base in terms of height, the better it is. So in this case, it is 15%, less than 15%, which is fantastic. Then let me draw the contractions or corrections in the base. So this is point 1. This is point 2. This is point 3. This is point 4. And this is point 5. As you know, if you have been watching my videos, I need minimum 4 points in the base. 4 points means 2 corrections in the base. So this is one correction and this is another correction. Okay. We don't have the third correction yet because point number 6 is not yet complete. Point 1 is the highest point in the base. Point number 2 is the lowest point in the base after point 1. Point 3 is the highest point in the base after point 2. Point 0.4 is the lowest point in the base after point 0.3, and 0.5 is the highest point in the base after 0.4. So you go from highest to lowest to highest to lowest. So you want to see price contraction. As you see these corrections in the market, you want these corrections to get smaller and smaller. Okay. So you want to see price compression. In addition to that, you want to see volume compression. So from here till here, you want to see volume declining, which is what we get here. The volume seems to be declining. Okay. Majority of the bars are below the blue line. Now, what does that mean? What does it mean when the volume is below the blue line? The blue line, this blue line is the 50-day simple moving average of volume. So if the bars, majority of the bars are below the blue line, it indicates that the institutions are not selling. It indicates that the institutions are accumulating the stock inside the base. It indicates that the weaker players, the smaller retail players, are trying to book profits because maybe they bought the stock early. Now they are selling their stock. And who is buying that stock? The institutions are buying that stock, right? So when the weaker players, the retail traders are selling the stock, the volume is obviously going to be small, right? Because retail traders do not come up with huge volume in selling. When institutions begin to sell, that is when you see large red bars on the volume chart, where institutions are trying to dump the stock or do heavy selling in the stock. That's not what we see here. So basically, you have price contraction, you have volume contraction, which is fantastic, which is exactly what we want to see. Another thing I want to see in the base is the number of candles. I need minimum 10 candles in the base. 5 candles means 1 week. This is a daily time frame chart, which means 10 candles is equal to 2 weeks. I want minimum 2 weeks of consolidation. I want the stock, after it has created point 1, I want the stock to rest for at least 2 weeks before it starts its new leg again. Okay. I don't want the stock to rest for 3-4 days and then start the next rally, because 3-4 days is too small. Okay. Imagine you are climbing a mountain. Okay. You are not going to climb the mountain in one stretch. You will first climb certain part of the mountain. Then you will set up a base camp. You will take some rest. Then you will start climbing again. Then again, you will set up a base camp. You will take some rest and then you will start climbing. That is how a stock should behave. Now imagine you are trying to climb a mountain. Okay. You are climbing for a couple of hours. Then you set up a base camp. And in the base camp, you rest only for 3 minutes. And then you start climbing again. Well, that's not enough of a rest to regain back your energy. It would take you more than 3 minutes to set up the tent, to set up the base camp. Okay. And after setting the base camp, you are only resting for 3 minutes. Okay. That is not correct. So you may have to you may have to rest for a long period of time before you regain your energy and start climbing again. That is why I need 10 candles in the base. So here you can see this is point 1. So I start counting from the next candle after point 1 candle. So 1, 2, 3, 4, 5, 6, and so on. There are comfortably more than 10 candles in the base. So let me repeat the criteria. The blue, the green, the red, the 50-day moving average, the 150-day moving average, and the 200-day moving average. We have all of them aligned. It's a stage 2 uptrending stock. You have 10 candles in the base. You have 4 points in the base. You have 2 contractions or compressions in the base. That's it. That's the criteria I need to buy the stock. Now everything is fine here. Then the question is, why did I not buy the stock? Okay. Let's understand this base a little deeper. Okay. Have a look at this base. Point 1, point 2, point 3, point 4, point 5. Obviously, point 3 is going to be a buy point. Okay. Now, where does point 3 come? Point 3 comes in the green zone. As you know, the green zone is the top quarter of the base. The blue zone is the second quarter of the base. And the red zone is the lower half of the base, which consists of the third quarter and the fourth quarter. Okay. So the buy point is in the green zone, which is fantastic, which is very, very encouraging. Okay. So if the buy point is in the green zone and if I have only 4 points, I'm comfortable taking the trade. Okay. I don't have a problem taking the trade. However, if you look at this closely. Okay. Look at this latest candle. What does this latest candle represent to you? This is a daily candle, by the way. Do you see price contraction here or do you see confusion in the market? I personally see confusion in the market. Okay. Look at the volume. The volume is above average. If you check here, what's the volume here? 810,000 shares traded in a single day against average volume of 739,000 shares. So the volume is above average. So if the volume is above average, okay, and you have an upper shadow and a lower shadow, equal upper shadow and equal lower shadow in that candle, okay, that is not encouraging. I would have wanted the entire range of this candle to be inside this candle. Okay, that's called a mother baby candle combination, or in Western technical analysis they call inside bar. So if the high and low of this candle is completely inside the high and low of this candle, that's called an inside bar. Then this candle would have completed point number 6. So the base would look like this. So point 1, point 2, point 3, point 4, point 5, and somewhere here would be point 6. Okay, if the high and low of this candle was inside the high and low or inside the high and low of the prior candle, then 6 points would have completed, and the fifth point would have been in the green zone, which is even more encouraging, right? So instead of yellow line here, the yellow line could have been here, and I would have bought the stock. Okay, but I did not get that. I was expecting a baby candle here, but I did not get that. Okay. So I decided, okay, let me wait. Now that the stock has created this, let me wait for a baby candle here. I want the high and low of the next candle to be completely inside the high and low of this candle. Now, if that happens, that would complete 6 points. Check again. See, point 1, point 2, point 3, point 4, point 5, and sorry, after this there would be some point number 6 here, correct? Let me draw it again. So this is 1, 2, 3, 4, 5, and somewhere here would be point number 6, provided the high and low of the candle is inside the high and low of the previous candle, which means we have an inside bar. If I get that candle, that would be very encouraging, correct? So I was waiting for that candle because I saw confusion on this day. I did not see contraction. I want to see contraction in the base. I don't want to see confusion in the base. Okay. Here at high volume, sometimes the price is going up, sometimes it is going down, and you have a small real body candle. That is not contraction. That is called confusion. Okay. That is why I decided to wait another day. Now, what is the risk? What is the risk if you wait another day? The risk is, what if the stock shoots up 20% in a single day? Okay, that's the risk. So if I don't buy the stock, and if the stock shoots up 20% or 10% or whatever in a single day, I miss that rally. Okay, that's the risk. Okay, but what's the advantage of waiting? The advantage of waiting is you come to know what the stock is really made of. Is the price really contracting, or is there still some supply left in the market? Are there still some retail players who would want to sell here if the price touches this yellow line? What if I put my buy order at the yellow line, price starts to go up, hits the yellow line, a lot of supply comes, and the price starts to come down? What if that happens? That's a risk to my portfolio, right? Because I will get trapped in the stock. So I want the stock to prove itself. If I see signs of confusion, I want the stock to prove itself. That is why I did not buy the stock. I decided to give it one more day. Okay, sometimes patience pays off. Another thing to notice here is you look at these two candles. Okay, the volume is low, but see, this is the selling volume and this is the buying volume. The selling volume, if you look at these three candles, the selling volume is more than the buying volume. Okay, and on this day, see, the stock has gapped up. Okay, the closing was here, the opening was here. The stock has gapped up on the opening and closed 3.70% higher. Look at this. closed 3.70% higher. But why did it do that on low volume? It means that the institutional players are not buying on that day. It's the retail people who are playing with the stock. Okay. It's the retail people who have pushed the stock up 4% on that particular day. If institutions were buying the stock, then this bar would have been above the blue line, correct? Here on above the average. But imagine stock going up 4% in a single day and you don't see institutions buying the stock. That's a negative sign. Another negative sign is that these two red volume bars are bigger than the buying volume. I don't like that. Okay. These are certain small nuances that I see in the base, which are not very encouraging. Okay. So that's why I decided, let me give this, what do you say, the benefit of doubt. Okay. Let me give it one more day. Let me see what happens on that day. And if it creates a baby candle, then I will choose to take risk on the stock. Okay. So that's one reason. Moreover, if you look at MarketSmith, this website that I use to filter stocks. So if I write, let's say, let's first log in here. It's already logged in. Okay. Write TD Power. If I write TD Power, see, look at this. The price strength is 73. Okay. I don't remember at that time when I was looking at the chart what was price strength, but the price strength is poor. The 73 price strength means there are uh, 27% of all the stocks in the stock market have done better than this stock. That's what this 73 number means. Okay. This simply means that TD Power Systems, the stock has done better than 73% of all the stocks in the Indian stock market on a 52-week performance basis. What does that mean? It means that there are still 27% of stocks in the Indian stock market which have done better than this company. Okay, so this company is not the highest ranked company in terms of price strength. That's a negative sign. EPS strength is fine, buyer demand is good, group rank is good. Okay, group rank means basically the industry or the subsector. Okay, that's fine, but price strength is not there. So there is weakness in the price. Okay, so if there is weakness in the price, don't you think that I should give it another day to see really what happens here? Okay, so that is why I decided that, okay, let us give it one more day. Let's see what happens. And look what happened. Exactly as I was suspecting. It goes up, it touches the yellow line, triggers my order, and then crashes back. Look at this downturn. Okay, 3.94% in a single day. And that too by touching this top. So from the top, from here till here, it's almost 6%. So the stock goes up 5%, and from there it crashes down 6%. That's almost 11-12% move in a stock in a single day. Okay, and that too on high volume. What does that mean? High volume, weak closing. What does that mean? It means supply. That is what we were discussing before even we saw this candle. I was suspecting that there could be supply in the stock. Okay, high volume means institutions have started to sell now. Moreover, weak closing means if the closing of the candle is below the midpoint of the candle, that's called weak closing. Okay. Now, what's the midpoint of this candle? Somewhere here. Midpoint means high plus low divided by 2. That's the midpoint of the candle. Now, obviously, if you see the closing here, the closing is below the midpoint of that candle. That means weak closing. So, high volume combined with weak closing, what does that tell you? It tells you institutions are selling the stock, at least on that day. Okay, I don't know whether they have been selling in the whole base. I don't see signs of that here, but at least on that day, the institutions seem to be selling. Okay, so my decision to not put the order or my decision to not take the trade was proven right by this candle. Okay, I got what I was suspecting. Okay, so when I look back, at the trades that I have avoided, sometimes my decisions turn out to be correct, sometimes my decisions turn out to be wrong. And I learn from that experience. I don't just reject a stock and forget about it. I keep the stock somewhere in my watch list. I keep a piece of paper and a pen, and then I see next day what happens. Okay. Now, if this stock would have shot up 20%, it would have created some pain in my heart because I did not put the uh, order at the yellow line. However, this creates joy in my heart because uh, I was right in this case. Okay. At least in this case, my analysis was correct. Okay. If I look at the nuances in the base. And look what happened today. Today the stock is up. Today the stock is up 0.99%. So basically, the stock still remains a stage two stock. So it is not the base that has failed. It is the pivot point or the buy point that has failed. Okay. If you read Mark Minervini's book, Think and Trade Like a Champion, the black color book, in that book, he talks about the failure of a base and the failure of a pivot point. This is not the failure of the base. This is a failure of a pivot point. Buying here was like buying the stock too early. Maybe you have to give more time to the stock to consolidate further. Now, if you see, now the base starts from here. Now this becomes point number one. So if I move this here, this becomes point number one. Okay. And this becomes point number two. The low of this candle becomes 0.2, this becomes 0.1. If you get 10 candles here in that consolidation, okay, if you get 10 candles, 4 points in the base, okay, volume contraction, price compression, and the moving averages are already there. So blue, green, red, 10 candles, 4 points in the base, 2 compressions in the base, contracting volume, I will buy the stock, okay. But this was not the correct time to buy the stock because this candle gave me an early clue that something might be wrong. Okay, there is some hesitation in this stock. Okay, so that is why I decided to stay away from the stock, and in this case, my decision was correct. So that is the reason why I have created this playlist. The name of this playlist is Trades Not Taken. It is important that I show you which trades I have avoided and which trades I have selected. Okay. The selected trades you will find in the playlist called as My Trades. So you can check both of my videos and see what am I looking in the stock before buying and what am I looking in the stock before rejecting it. When you combine these two knowledge, your skill of looking at the base will improve. You will also start rejecting and selecting bases or stocks like me. So here what we are trying to do is we are trying to improve our chart reading skills. Okay. We are not using too many indicators here. Okay. We are just looking at price and volume and basic price volume action to figure out what is happening and is this the right time to enter. Sometimes the base might be okay, the buy point might be okay. Sometimes even purely from a risk management point of view, it may not be the right time to enter. So if you see, I spend a lot of time understanding the base rather than spending time watching business news channels or trying to spend my time analyzing the market indices. I don't look at indices. Okay. I look at individual stocks and how they are doing because an individual stock might be in its own business cycle, might be in its own early, what do you say, earnings cycle. Market might be going down, but there are some stocks that are going up. Why does that happen? Because the business behind the stock might be doing well, or there might be some other reason. Maybe they applied for a patent, it got approved. Maybe a legal case was dropped against the stock. Maybe they are buying shares buy their own shares. We don't know the reason. All I see is the chart and the price and volume action in the chart, and that gives me certain clues. And it tells me what is the right time to buy the stock, what is not the right time to buy the stock. So this series is very important. Save this you save this playlist somewhere you so that you can come back to this playlist and watch the videos over and over again. That is how you learn. We learn more by repetition. So I hope this video was helpful to you. Interesting to see that I avoided the trade and you get a fake out. This is called as a fake out, by the way. So this candle is called as a fake out candle because it was trying to trap you. It was trying to force you to buy here. Then it goes up, giving you an illusion that it will continue to go up. See, by the time the price reaches here, you are looking at a large green candle, and that creates joy in your heart. But by the time the day ends, all that joy evaporates, it disappears. Okay. So these kind of things will happen to you in the market, no matter what trading system you use, no matter what you're trading, whether you're trading futures, options, forex, commodities, stocks, I don't care. Every trader goes through these kinds of fake out price actions. Okay. And we need to be prepared for these kind of price action. Even if I would have taken the trade, I would have kept a stop loss to a level where my loss is limited, or I would have reduced my position size just 5 minutes before this close of the day to limit my risk. Okay. So I hope you liked the first video in this series. Let me know in the comment section. I will create more videos like this. It is important to discuss which trades I have taken, but it is more important to discuss which trades I have avoided. Okay. That will help you learn even faster. Thank you so much.